In this video, I'm going to present to you one of the most misunderstood stocks and one of the most predictable stocks in the entire stock market, which is actually Dropbox. And it just makes me laugh whenever, I talk about Dropbox, because I've been in and out of the stock for years. The stock is pretty much trading below than where it was trading at on IPO in 2018, yet the company has grown revenues, free cash flow, net income, bought back stock, did everything you want. But just the stock keeps going down and it keeps trading within a range of between 19 and 24. And I've done it countless of times where I bought the stock at 19 to 20 and then I sell it at 24. And then I just know where it's going to go. It's going to go back to 19, 20. And I noticed Seth Klarman actually doing that. I've been watching his portfolio. He buys it around $19, $20 and then he trims his position around 23 to 24. So I've been doing the same since pretty much 2022. And it's been, again, one of the easiest money I've ever made. But I'm not here to show you how to trade Dropbox, although it's pretty tradable and pretty predictable. I'm here to talk about the business in general and tell you why Dropbox is one of the funniest and pretty much misunderstood stocks, in the stock market. We're going to analyze the business model, some of my valuation models, some of their margins, some of their net income and stuff, and determine a very good buying opportunity for Dropbox. So again, I hope you enjoy this video. Now, most of you are actually familiar with Dropbox. I'm sure you had it on your phone. Maybe you don't use it anymore. Maybe you use Google Drive, or you use, maybe Apple storage, iCloud or whatever. Maybe you just don't use Dropbox anymore. But Dropbox still has over 700 million registered users. Out of those 700 million, 17.7 million are actually paying users, which is, again, a big margin, but they still have paying users and they've actually been growing. And I'm going to talk about that a little bit more. But the beauty about this whole thing is Dropbox really doesn't have to spend a lot on trying to advertise Dropbox. They try to sell their services to the already registered users on a free subscription. They try to sell them a paid subscription. And they have expanded and integrated many acquisitions like Dropbox Sign, which is a competitor to DocuSign and Adobe Sign, and it's pretty small, but it has been actually very successful. And then they have something called Dropbox Send, and they recently acquired something called Swift, which I'm not familiar with. I haven't looked deep into it, but this is what they basically did with Dropbox Sign and DocSend, and they combined it all in a subscription model called pretty much Dropbox Team, where there's a virtual type of team space and people can do business and collaborate, and then e-sign the document with the Dropbox e-signing. They can send them with Dropbox DocSend, and they integrated all of those into one plan. And over 35% of the paying users are actually, team members. They use it for business. Over 50 to 60% of Dropbox, they use it for business, which is why we talk about it sometime and we say, yes, Dropbox is definitely facing a lot of competition. And many of you would ask yourself, why would you use Dropbox if you could use Google Drive for pretty much free? Well, that's maybe because you're not a business person. If you're a business person, you want, something a bit more professional. You want something that's integrated within a e-signing of document, within DocSend. You want something that's a pretty good bundle, which I've gone over in my previous videos on Dropbox. This is not my first video, but a lot of professionals actually use Dropbox for, business. And again, the numbers speak for themselves. Even though the company is still trading below their IPO levels. If you look at their financials, their revenue is up every single year. The free cash flow went up from 491 million to 764 million. And their target is 1 billion of free cash flow by 2024, which I'm not sure if they can achieve because it looks like it's slowing down. But again, we're not going to take a look at the free cash flow because of the high stock-based compensation. But again, their gross margin is at 82%. You might think this is valued at 20-25 PE stock. It's only sitting at 12 times earnings with 82% gross margin. And their non-GAAP operating margins went from 21% to 31%. So looking at those metrics, looking at the paying users from 15 million to 17.7 million, looking at the average revenue per user from $128.50 to $134.51, you can clearly tell that Dropbox is not a dying business. It's not something that just, being eaten by competitors. Of course it is, but it's also a sticky product, and it's pretty hard to move from Dropbox and go sign up for something else. If you have your business or your school, a lot of universities use Dropbox for the students and stuff. So those systems are pretty hard to change, and they are very, very sticky, which is why they have been able to grow their paying users, even though if it's slow growing, but they were still growing. They are not declining on any single metric. Yet the company is still trading below its IPO level, which is why it's pretty funny to me. Now, looking at their balance sheet, it's a little bit messy. They have around $1.3 billion of short-term investments in cash and cash equivalent, which is more than their current liabilities, which they covered, which is something great. Now, they have some long-term debt, which is around pretty close to $1.4 billion. That's pretty high long-term debt for the company. It's only a $7.7 billion company. But it's not a big concern for me. Why? Because most of the debt is not due before 2026 to 2028. And the interest rate is only 32 basis points and 22 basis points. I mean, 0%, pretty much free. So they had a pretty good deal whenever they did the debt restructuring in 2020 when we had 0% interest rate. That was pretty successful, from the management. So again, if I was them, I would not be paying the debt with such low interest rates, which is exactly what they did. They haven't been paying down the debt, but they have been buying back stock instead. But they also have a stockholders deficit, which is something I don't like. I don't really like seeing positive stockholders equity, and the main reason for the deficits, they have over 2.7 billion of accumulated deficit. These are loans they took and stuff to start up the business and do expansion and a lot of things, which is again something I'm not a big fan of, but I believe it's okay as the company did a lot of buybacks and is not paying its debt on intentions because of this low interest rate with this whole thing. But taking a look more at Dropbox, as I said, is only trading at 12 times earnings. The mean for the company is 20 times earning, and it traded as high as 34 times earning. Now, normally, whenever you have software as a service type of business that's growing on every single metric, where you have a subscription-based revenue with over 81%, 82%, gross margins and 24% net income margin, I don't believe this company should be trading at 12.5 times earnings. But this is, again, just my opinion, and clearly the market has not agreed with me. But now, with the company trading at 12.5 times earnings, the lowest it traded since it went public was around 12.10 times earnings, which were pretty close to the lows in terms of valuation with Dropbox. And as I mentioned, they have been aggressively buying back their shares, over 5% buyback yield of every single year Dropbox has been buying. So they reduced their share count by more than 5% every single year. But all of this doesn't matter. We don't care about everything. All we care about is actually my valuation model, which is really going to tell us if Dropbox is in fact undervalued, is it overvalued, or is it actually a value trap? And this is my valuation on Dropbox. On current revenue, I put in 2.3 billion, which was the revenue for 2022. I put in 6% compounded of revenue growth from 2023 to 2027. Although Dropbox has been growing between 8 to 10 to even 12% before now. But as maybe more competition is going to slow down the revenue growth, so I went with a conservative 6% revenue growth, which I believe you guys can agree that it's actually fair. Now, using a net income margin of their 24%, which is what they currently have, 24%. PE ratio now is trading at 12 times earnings. Now, I personally believe that the company at least should be trading at 15 times earnings with a software as a service business model with, yes, they have growth, they have higher margins, they have a sticky product, which is really hard to switch from, and they have growing users, growing average revenue per users. So I believe 15 multiple is pretty fair for the company. For a dividend, which is actually a buyback, I put in 5%, meaning meaning they can continue buying back 5% of their market cap every single year. So taking all those numbers into consideration, we get around a 76% on the upside, or only 14% compounded every single year for the next 5 years. Now, this is actually not bad at all for a company, like Dropbox, but unfortunately, it's still not a double. And this is really what I'm looking for in my investments. I try to double my money every 3 to 5 years. Now, if Dropbox does trade maybe at 20 times earnings, and maybe the market wakes up, and if the stock trades at 20 times earnings, then you're looking at a massive 20% compounded, or over 127%. But this is not something I really want to bet on. Therefore, the share price required for me to get a double in Dropbox is around $19.20 per share. Meaning if Dropbox trades at $19.20 per share, I would get 100% back on my money over the next 5 years, maybe even before 5 years if the market actually loves Dropbox again. But as I said, if you're more of a trader than an investor, Dropbox is a pretty predictable stock between $19 and high 24, maybe low 25s per share. You could buy it pretty close to 19 and sell it above 20. This is not financial advice, but this is what I've been personally doing since, pretty much 2022, and I have been, successful at it, and maybe I do it again, maybe I don't. So you watch this video, you could do your own research and make your own decision if Dropbox is a buying opportunity for you or not. Thank you for watching this video. If you enjoyed it, please press the like button and maybe consider subscribing. So I hope to see you in another one.